It's 23:30 on January 24th, 2026. The markets closed hours ago, but I can't sleep. I've been staring at the same data patterns for 3 hours and something isn't sitting right. While everyone's celebrating another record week for silver, while the financial media runs victory lap stories about retail investors finally being vindicated, I keep seeing timing coincidences that make my hair stand up. I'm a private commodities analyst who's been tracking precious metals flows for 16 years. I built this channel because I got tired of waiting for mainstream outlets to ask the uncomfortable questions. And tonight, I need to walk you through something that's been bothering me for weeks, something about the silver rally that feels too coordinated, too perfect, too convenient. Here's what I'm questioning, and I want you to understand I'm not making accusations. I'm raising questions that every intelligent investor should be asking themselves. The timing of this silver rally aligns almost perfectly with several institutional positioning cycles. The narrative building has followed a textbook pattern that mirrors previous market manipulation campaigns, and the social media coordination around silver shortage stories shows levels of synchronization that rarely occur organically. This isn't about being bearish on silver. This isn't about calling the rally fake or predicting a crash. This is about pattern recognition. This is about asking whether the confluence of events driving silver higher represents genuine market forces or something more orchestrated. Because if you've been in these markets long enough, you know that when everything aligns too perfectly, that's usually when smart money is setting up retail money for disappointment. Let me walk you through the timing anomalies that have been accumulating over the past 6 months. Because the more I dig into the sequence of events, the more I wonder whether we're witnessing authentic price discovery or sophisticated market engineering. The first red flag was the synchronized media narrative that emerged in late August 2025. Suddenly, every precious metals publication, every YouTube channel, every social media influencer was talking about industrial silver demand exceeding supply. The stories all featured the same data points, the same expert quotes, the same alarming projections about electric vehicle adoption and solar panel manufacturing. That level of narrative coordination doesn't happen by accident. Information flows in financial markets are messy, contradictory, and fragmented. When you see unified messaging across multiple independent platforms, it suggests either a single source feeding information to multiple outlets or coordinated distribution of talking points. Neither scenario represents organic market sentiment formation. The second timing issue was the ETF flow patterns. Starting in September, we saw massive inflows into silver ETFs that preceded rather than followed price moves. Normally, retail investors chase performance. They see prices rising, get excited, and buy ETFs after the move has already started. But in this cycle, ETF inflows often preceded price spikes by 24 to 48 hours. That's institutional positioning masquerading as retail demand. Think about the logical sequence. If genuine industrial demand was driving silver shortages, you'd expect to see physical premiums rise first, then spot prices, then ETF flows as retail investors react to the price movement. But we saw ETF accumulation happening before spot price moves, which suggests the ETF buying was causing the price increases rather than responding to fundamental demand. The third pattern that bothers me is the industrial demand projections themselves. Every report I've seen extrapolates current growth rates linearly into the future without accounting for price elasticity, substitution effects, or economic cycle variations. The solar panel industry will need X millions of ounces. Electric vehicles will require Y millions of ounces. Data centers will consume Z millions of ounces. Add them up and you get demand projections that exceed supply by ridiculous margins. But these projections assume demand is completely price inelastic. They assume no technological substitution occurs as prices rise. They assume no economic downturns reduce industrial activity. They assume perfect linear growth in every silver-intensive industry simultaneously. Those assumptions are economically naive, but they're perfect for building a scarcity narrative that justifies higher prices. Now let me show you the historical parallel that keeps me awake. In 2010 and early 2011, we saw identical narrative building around silver industrial demand. The story then was that silver was being demonetized and becoming a pure industrial commodity. Solar panels were going to consume massive quantities. Electronics manufacturing was accelerating. Industrial demand would overwhelm mining supply and force prices dramatically higher. The social media coordination in 2011 was less sophisticated than today, but the pattern was identical. YouTube channels, online forums, and early social media platforms all pushed the same messaging simultaneously. Silver shortage. Industrial demand explosion. Buy now before it's too late. The timing was too coordinated to be coincidental. And what happened? Silver went from $18 to $50 in 6 months, then crashed to $26 and spent the next decade in a bear market. The industrial demand story was real, but massively overstated. The shortage was temporary and largely artificial. The retail investors who bought into the narrative at 40-50 watched their positions lose 50-70% of their value and never recover. I'm not saying we're in identical circumstances today. The macro environment is different. Inflation dynamics are different. Geopolitical tensions are different. But the narrative structure and timing patterns are remarkably similar. And that similarity should make anyone who lived through the 2011 cycle at least pause and ask critical questions. Here's what's particularly suspicious about the current cycle. The shortage stories all seem to emerge from a small number of industry publications that cite the same research firms and quote the same analysts. Independent verification of physical supply constraints is difficult because most of the data comes from interested parties. Mining companies want higher prices. Industrial users want to justify inventory building. Financial firms want to generate trading commissions. The social media amplification of these shortage narratives also shows unusual coordination. You see the same key phrases, the same statistics, and the same calls to action appearing across multiple platforms within hours of each other. That kind of synchronized messaging typically indicates either coordinated campaigns or algorithm-driven content amplification, neither of which represents authentic grassroots sentiment. But here's where I need to be careful because I'm walking a line between healthy skepticism and conspiracy thinking. It's entirely possible that the silver rally is driven by genuine fundamental forces. Industrial demand could be accelerating faster than historical norms. Supply constraints could be more severe than previous cycles. Central bank monetary policies could be creating legitimate demand for hard assets. The challenge is distinguishing between authentic market forces and manufactured narratives. And the only way to do that is by looking at the data that's hardest to manipulate. Physical flows, industrial inventory levels, mining production statistics, import-export data from customs agencies. These data sources are slower to report and less convenient for building narratives, but they're also less susceptible to manipulation. What I'm seeing in the hard data is more nuanced than the shortage narrative suggests. Yes, industrial demand is growing, but it's growing at rates consistent with normal economic expansion, not the explosive growth rates implied by the projections. Yes, mining supply is constrained, but it's constrained by normal geological and economic factors, not artificial restrictions that create acute shortages. The disconnect between the narrative and the underlying data makes me wonder whether we're seeing market sentiment manipulation designed to create the conditions for a significant price reversal. Not necessarily a crash, but a sharp correction that shakes out retail participants who bought into the story at elevated prices. Here's my framework for evaluating whether the silver rally is sustainable or artificial. I'm watching 3 specific indicators that should reveal whether we're dealing with genuine market forces or orchestrated positioning. First, the correlation between industrial purchasing patterns and spot price movements. If the demand story is authentic, industrial users should be increasing their physical inventory purchases consistently. But if the rally is financially driven, industrial purchasing should show price sensitivity as users delay purchases hoping for lower prices. Second, the behavior of commercial traders in the futures market. The commitment of traders reports show positioning by different participant categories. If large commercial users are hedging increased production or inventory needs, their positioning should be consistent with the industrial demand narrative. But if commercial positioning contradicts the shortage story, that suggests the narrative isn't supported by actual industrial activity. Third, physical premium behavior in different geographic markets. Genuine shortages create regional price differentials as physical metal flows to where demand is strongest. But if premiums remain uniform across different markets, it suggests the shortage is more perception than reality. What I'm seeing in these indicators is mixed signals. Some data supports the bull narrative, some data suggests caution, and that ambiguity is exactly what you'd expect to see during sophisticated market manipulation, where enough genuine activity exists to provide plausible cover for artificial positioning. The timing of this analysis matters because we're approaching what I believe will be a critical inflection point. The institutional players who potentially orchestrated this rally need to monetize their positions before economic or policy changes undermine the narrative foundation. That typically happens through retail participation spikes that provide liquidity for institutional exits. If I'm right about the artificial nature of the rally, we should see specific warning signals over the next few weeks. Sudden shifts in ETF flows, changes in social media messaging tone, modifications to industrial demand projections that make them more conservative. These would be signs that the narrative builders are preparing for position liquidation. But if I'm wrong, if this rally represents genuine fundamental shifts in the silver market, then the current price levels could be sustainable or even conservative. Authentic industrial demand growth combined with legitimate supply constraints could justify much higher prices than we've seen. The challenge for individual investors is making decisions with incomplete information while institutional players have superior access to real-time data. That asymmetry is why timing becomes so important in these cycles. Retail investors typically receive the most convincing narrative, just as institutional investors are preparing to take profits. My personal approach is defensive positioning with trigger-based decision-making. I'm not betting against the silver rally because I could be wrong about the manipulation hypothesis, but I'm also not adding to positions at current levels because the risk-reward ratio has shifted unfavorably. If you're right about a continuing rally, you make moderate profits. If you're wrong about a significant reversal, you take large losses. Instead, I'm monitoring the indicators I mentioned for signs of either narrative validation or narrative breakdown. If the data starts supporting the shortage story more convincingly, I'll increase exposure. If the data starts contradicting the narrative, I'll reduce exposure. This approach avoids both the fear of missing out on further gains and the risk of major losses if the rally reverses. The key insight is that market timing matters more than market direction when you're dealing with potentially artificial price movements. Being right about direction but wrong about timing can be financially catastrophic in volatile markets. Being approximately right about both direction and timing, even with imperfect information, is usually sufficient for acceptable investment outcomes. What keeps me concerned is the retail enthusiasm I'm seeing in silver forums and social media groups. The confidence levels, the dismissal of skeptical viewpoints, and the certainty about future price movements all mirror the sentiment patterns that preceded major corrections in previous cycles. When everyone agrees that something is a sure thing, that's typically when the sure thing stops working. This doesn't mean silver prices can't go higher, but it does mean the easy money phase of the rally may be ending. Future gains will likely require either stronger fundamental support than currently exists or continued narrative refinement to maintain retail participation. Neither scenario guarantees success, and both scenarios carry significant execution risk for the institutional players potentially managing this rally. The silver market deserves skeptical analysis precisely because it's been subject to manipulation attempts throughout its history. The 1979-1980 Hunt Brothers corner, the 2011 retail enthusiasm bubble, multiple smaller manipulation episodes documented by regulatory agencies. This history doesn't prove current manipulation, but it justifies extra caution when evaluating rally narratives that seem too perfectly constructed. My recommendation is simple. Question the timing, verify the data, watch the institutional positioning, and remember that in financial markets, things that seem too good to be true usually are. The silver rally may be authentic, but it's exhibiting enough suspicious characteristics to warrant defensive positioning and critical thinking rather than enthusiastic participation.